Hello, everyone. Today on the Final Bar, we'll wrap the week as we do every Friday. Look at how the markets have evolved from last Friday's close to this Friday's close, particularly what happened in the market today. The market snatching victory from the jaws of defeat almost, with the S&P and the NASDAQ rallying going into the close. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform is really designed to empower investors to understand and illuminate the markets using the technical analysis toolkit. Technical toolkit really relates to supply versus demand, fear versus greed. I would argue in recent days, recent weeks, even recent months, we've seen a lot of both, right? We're not just seeing an overwhelming amount of fear, which tends to create a waterfall decline. We're not seeing an overwhelming amount of greed or optimism, which tends to push things onward and ever upward. We're sort of in that choppy, sloppy, sideways phase where fear and greed, those opposing forces, are tending to net out. Now, having said that, there are areas of the market that are particularly strong. In our Wrap the Week segment, we're going to dig a little bit into some of those leadership areas of the market year to date, things like mega cap, tech, and communications names, gold, and elsewhere, and see what all we can find. Let's get to our Wrap the Week segment. We are going to start with a poll. We always have a poll running on our live stream page at StockCharts.com and our social media accounts. We actually asked you about the presidential cycle this time. How important is the presidential cycle or the four-year cycle in your analytical process? Very important, somewhat not very, or what's the presidential cycle? For the poor and sad 6% of you that said you don't know what the presidential cycle is, shame on you, number one. Number two, go to the chart school portion of our website, search for the information on cycle analysis, because the four-year cycle, always important, but especially now, the midterm election year to a pre-election year, vital, I think, to understanding it. Most of you said, it's somewhat or not very important. I would tell you there are times when I found cycles to be more or less meaningful. I would say right about now, particularly with how accurately the four-year cycle has tracked the performance of these markets, I think it's a pretty good time to get more comfortable with it. If you're one of those people that say you don't pay too much attention to it. One of our guests next week, Jeff Hirsch, really, his father, Yale Hirsch, was one that popularized this idea of the four-year cycle. We'll get his firsthand take on what he's seeing in the markets going forward. Let's continue our Wrap the Week segment, looking at what happened in the markets today. As I mentioned, we look at the little two-day preview chart. Yesterday we talked with Clint Cowles of Charles Schwab. We were talking about sort of the short-term rally, phase just yesterday. Nice recovery through the course of the day. Today actually opened higher, but it got real negative real quick. In an early afternoon session, this felt like the S&P may not just hit 4,100, which it did touch barely right around 2 to 3 p.m. Eastern, but go much further down. It just felt like this consistent deterioration. In the last hour of trading, you will often find a big change in sentiment, and that is because the first 30 minutes, the last hour, is where you have a bulk of the volume during the trading day. Early in the morning, sort of the retail period, this is when there's a lot of short-term and initial reaction to pre-market announcements, to news flow, to futures trading, all of that sort of things getting started. But a lot of institutions, a lot of ETF rebalancing is waiting until the last hour, and that's more the institutional hour where a lot of big volume will come in and positions are made. So a lot of institutions, again, my simplistic read of the dynamic of the day, a lot of institutions buying in, going into the close, not enough to push the major averages into the green, but enough to make what started to be a real negative day to a much less negative day. Having said that, the S&P 500 finishing down about 0.2%. It's just below 4125. So it did bounce off of that 4100 level, remaining above there. Again, nowhere near yet in the short term that 4200 level. That's an important level we'll talk about in a little more detail in just a short while. The NASDAQ Composite, the NASDAQ 100, both down about 1/3%, so actually underperforming the S&P, and the Dow was almost flat for the day, right around 33,300. Mid caps flat, small caps down, and one of the worst performers today along the lines of the NASDAQ. The VIX pushing up just a little bit, but just the slightest amount, really is about the same as where it was yesterday. So the VIX is kind of remaining around that 17 level. Again, well below 20, which is sort of my back of the envelope. Generally speaking, are we in a high or low volatility environment? The level 20 is the one that I always kind of start with. So continuing to be below there, which we've been below there for a while now in the last 6 to 8 weeks, suggesting low volatility environment, which is exactly how this feels, right? It feels like things aren't moving as much. Although, having said that, you get things like First Solar gapping higher, 26+%. So don't get me wrong, there are moves out there, but in general, volatility is certainly a little lighter than average. Certainly less than we saw in 2022. Let's look at interest rates here. We've talked a number of days this week about rates moving lower, sort of the entire yield curve coming down. Today, a bit of a mean reversion. Bond prices actually came off. The TLT was down about 0.8%, and the whole yield curve sort of moving to the upside here. The 10-year point, which is where we tend to focus our attention, ended the day around 346. Long bond yields a little bit higher, around 378. The dollar pushing higher as well, and that's part of that sort of story that we saw through the course of the day today, with risk assets a little bit weaker, the dollar a little bit stronger, and the UUP was up about 0.2%, really pushed higher through the course of the day. Let's look at commodities here. A bit of a mixed bag, but overall, on average, a little more negative than positive. The DBC is sort of a broad commodity ETF. That was down about 0.8%. Gold and silver prices down as well. Gold not down too much, to be honest with you. Silver prices sort of led the way lower. Copper prices actually bouncing a little bit higher. They'd been weaker as of late. So again, sort of a mean reversion move to some of the trends we've been talking about through the course of this week. Cryptocurrencies, it's been getting rough here, and a lot of these bounced right into the close of the equity session, which is making this look a lot more attractive than it was just a couple hours ago. Bitcoin and Ether both having a pretty rough day until, again, just this spike going into the last couple hours of equity trading. Bitcoin just below 26,500. That's down about 2%. And Ethereum well below 1,800, down about 0.5% from yesterday. Just briefly on sector movements today, and then we'll look at what we call our wrap the week chart, looking at the last 5 trading days. Sort of defense at the top. So even though the markets, sort of rallied into the close, it was the defensive stuff like utilities and consumer staples that were getting it done on a relative basis. Utilities led the way higher, up 0.6%. Consumer staples up 0.4%. And if you're not in the staples trade, either literally with a position or mentally, a good time to be considering it, because charts like Pepsi continue to work. Charts like Hershey's have been, some of the stronger charts year to date, to be honest with you. So certainly some potential for continued upside there. Energy number 3, which has been one of the weaker sectors year to date. On the downside, you had consumer discretionary actually down 0.9%, followed by financials, which has been really a chronic underperformer in 2022. Healthcare as well, but down just a slight amount, around 0.2%. Let's look at what we call the wrap the week chart. This is just looking at the last 5 trading days. So we're using the performance chart type. So this is using Sharp Charts. But within Sharp Charts and also StockCharts ACP, our advanced charting platform, you can use a type of chart called a performance chart. And what that does is it basically starts the clock at a certain date, and then you're looking at the movements, the percent returns from that starting point to where we're at today. And it's a great way to just look at performance over a period of time. Year-to-date performance, pretty helpful for that. I like to look at on a Friday just to see what happened over the course of the week, because it's easy to get sucked into the short-term fluctuations, what we call the flickering ticks day to day. Now let's look at sort of the longer-term trends and how they've evolved. Here's the S&P, which is the line in black. Finished the week down about 0.25%. Gold underperforming just slightly, down 0.4%. In red, we have bond prices. The TLT is down 0.6%. In purple is the Russell 2000, so small caps down 1%. In brown, we have crude oil using the USO, which is down 1.5%. The worst performer here out of this group is the emerging markets ETF, down just over 2%. A couple things were actually positive on the week, and just 2 out of this list. The NASDAQ 100 actually finished, even with today's slight pullback, up about 0.7%. And the big winner of the week, the dollar, up 1.6%. Last year, we called the dollar the wrecking ball for risk assets. And this week, sort of back to that true form where the dollar's stronger and a lot of other things are weaker. Here's the thing, though. We didn't include cryptocurrencies. If we do add Bitcoin on the list, you can see it was a rough week with the Bitcoin from last Friday to today down about 10.4% over the course of the last 7 days. Going back to the dashboard, I want to show you these two charts. One of the really cool features of the dashboard, and just to give you a quick preview, we're working on a whole new configuration of this page called panels, where each one of these is a separate panel. We're going to allow you to create different panels, make your dashboard look however you like, give you a lot more flexibility, eventually create your own panels. There's a lot of really cool stuff that our development team is working on. I cannot wait to show it to you, but we're going to go ahead and make sure that it works all perfectly just first. So later this year, I'll be able to share some of that with you. But one of the cool features we have now is you can embed charts directly on your dashboard. I have two charts that I refer to so often that I have them sitting directly here on my dashboard. This is my market trend model, which looks at the long-term, medium-term, and short-term trends, all using weekly data. So it's using weekly closing data on the S&P, and then a series of exponential moving averages using the weekly time frame to address the time frame address the trend on these three different time frames. If the histogram is above zero, the trend is positive. If it's below zero, the trend is negative. The long-term model remains positive. It turned positive in April. You can see the medium-term model remains positive. It's been positive for most of 2023. The short-term model earlier today was going to turn negative, but with the nice rally into the close, it kept it slightly to the positive side. So I don't have a neutral setting on this market trend model. If I did, the short-term model would definitely be neutral, but for now, it's binary, and it's still clinging just barely to that bullish sign. So by my read, the trend on 3 time frames is still positive. This is a chart that I simply called the chart combining 5 key measures of performance. We'll finish up here. You can see the S&P overall, while still, in an uptrend, I guess, not going any higher, right? Not making higher highs. S&P needs to get above 4,200 to really complete that. We talked earlier this week about the new Dow theory. And I did a YouTube video on that on my channel called Market Misbehaviors. Check that out if you missed the discussion there, because unless we get above 4,200, it's really not confirming that we're still in a bull market phase. A bit of a concern that the advanced decline line is really sloping downwards. This is the New York Stock Exchange AD line. So while the S&P is holding in near previous swing highs, the AD line is actually in a steep downtrend at the moment. Neutral reading for the percent of stocks above the 50-day, it's about 48%. Almost to the second, to the penny here, the bullish percent index on the S&P 500 is literally at 50%, which means 250 out of the stocks are in a bullish point and figure chart. The other 250 are not. And that is the definition of a sideways market, waiting to see which way we head from here. John Murphy posted a note to our members just earlier today, and if you missed that, make sure you check it out. But talked about the breadth deterioration. One of the things I look at is leadership. The defensive area of consumer staples continuing to outperform the offensive area of consumer discretionary. Let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is a pleasure to put this show on for you every day. We've got a great team here at StockCharts TV helping us to get this message out to all of you every day. Tell your friends. We have a lot of really good friends, a lot of really good opportunities and plans for this show and for the StockCharts TV studio, and look forward to giving you some new ideas and new content through the course of this year and beyond. A couple quick announcements before we open the Final Bar mailbag. Our mailbag is fueled from questions from people like you. If you can email us your questions at thefinalbar@stockcharts.com, that's the best way to get a hold of us. We're also on Twitter at FinalBarSCTV, and we are on YouTube. Check out our YouTube channel, subscribe to it, hit a like on the videos that you're watching, but also put a comment below. We'll capture those. Hope to answer one of your questions live on the air on Monday's show of next week. Upcoming schedule, we had 3 really good guests. I had fun talking with Clint Cowles yesterday. Jay Woods from the floor of the New York Stock Exchange earlier this week was a lot of fun. Next week, we have Danielle Shea of Simpler Trading. She's actually going to be live in our studio here in Redmond on Tuesday the 16th. She does a great job analyzing the markets with the team at Simpler Trading. We'll have her here and talk about some of the charts she is watching this next week. Jesse Felder of the Felder Report will be joining us remotely from Arizona on Wednesday the 17th. And then Jeff Hirsch from Probabilities Fund Management, editor of the Stock Traders Almanac, son of Yale Hirsch, who created the Stock Traders Almanac, was the editor for years and years. Jeff's fantastic, really knows market seasonality and market trend, and just recently had a signal that he'll be sharing with us on the show next Thursday, the 18th. Let's continue today's show with the final bar mailbag. Please keep your great questions coming, and let's get to question number one. Dave, is this a cup and handle pattern for GLD? And I just want to point out, you actually sent that question in on our YouTube channel after watching the Charting Forward, our mid-year sort of second quarter market outlook. Had such a fun time talking with T.G. Watkins, Miss Schneider, and Julius DeKempener here in the studio. And if you missed that, check it out on our YouTube channel or on StockChartsTV.com, our on-demand platform, our app as well. Really interesting discussion. We had a lot of different things that we touched on, but we did focus quite a bit on gold and precious metals and what it means, not just from a trend following perspective that the trend is so strong, but also from a macro perspective, right? This sort of traditional store of value, a defensive play in a lot of ways, is actually trending, has been trending higher. The question is this a cup and handle pattern? And I have to say, not really. The best I would say you could label this would be a cup and handle like pattern, which is sort of technical shorthand for saying it's not a perfect example, but it's kind of like it. And I would say it's not a great idea. And I'll tell you why this is not a cup and handle pattern. A true cup and handle pattern, I'm talking like a textbook. You open up the book and it says, here's what a cup and handle pattern looks like. It needs a really consistent base, right? So you have, like, think of it as a cup, right? Literally a cup with an even rim of the cup, right? So your liquid isn't spilling all over the place. Then you have a shallow pullback, which is the handle. This is what a consistent rim would look like, and you have sort of this weird gap above there, and then the right edge is sort of far below. So you do have sort of this rounded bottoming pattern, but you didn't make it all the way up to the previous highs. You have this shallower pullback, which certainly looks like a handle, but again, it's not lining up so particularly well. So I don't think I would label it a cup and handle. What I would definitely label it as is an uptrend. And the fact that we have gone from a clear downtrend of lower lows and lower highs to a clear uptrend of higher highs and higher lows, 100%. We talked earlier in this week about sort of this trend channel that gold is in. I think my guest, Clint Cowles, yesterday, I feel like he had a chart with gold on there. I might be making that up. One of my guests, maybe Frank Capillari on Wednesday had done so. But we have talked about that. We've talked about the lows. And again, just keeping an eye on where the gold value is relative to the 50-day moving average, relative to this trendline support, could be pretty helpful. One thing that has started to change that I would say is sort of an area of potential concern would be this bearish momentum divergence. And that's when you have higher highs in price and lower peaks in momentum. And if there's a potential issue right now at the chart of the GLD, and I think this is mirrored on things like the GDX and other gold-related and gold stock-related ETFs, is the fact that we've made higher highs over the last 4 weeks to 6 weeks, but we're actually making lower peaks in momentum. Overbought in mid-March. Now we're not overbought here in April and then May. So new highs on weaker momentum is usually the sign of a trend nearing the exhaustion point. So I'd be certainly looking for signs of a rollover. For now, I would say the trend in gold is okay. And how do you tend to trade this, or how do I tend to analyze this? This sort of bearish divergence puts it on a very important watch list that I keep, which is a list of things, a list of charts that I'm actively watching for breakdown, sort of like the breakdown alert checklist. And I put an alert to show what level would tell me that no matter what, I need to revisit this chart. Maybe it's a break of the 50-day moving average or something like that, but I certainly pay attention to those charts. I think gold might be a really important one to watch going into next week. Thanks for that question, by the way. And again, I'll share other examples of cup and handle patterns that are more idealized going forward. I hope that'll help you make sense of why this one may not be an ideal one. Next question. For something like the S&P 500, how important is it to break the exact resistance level? And I'm paraphrasing a pretty good long question that we received after my interview with T.G. Watkins. You're talking about, I think T.G. had made a comment on, the S&P tagged its February high. And one of the comments we got was, well, it didn't actually tag it, did it, right? It didn't actually get all the way up there, so you can't say that it tagged it. So here's the thing. I had a great discussion years ago with Arthur Hill that really helped me solidify how I think about support and resistance levels. What you have to remember is if you go back to like the Edwards and McGee book, or even the John Murphy, Martin Pring kind of classic books on technical analysis and trend lines and support and resistance levels, they really a lot of times accentuate, they stress the importance of hitting a particular level, right? That close is not close enough. You have to hit a precise level. What you have to remember is all of that was done when stocks were basically traded on eights. and you only had 8 different levels between each full dollar amount at which a stock could actually trade, right? So 12.5 cents was the narrowest gap from one trade to the next. Now we're at sub-penny trading, which means you're going to hundreds, if not thousands of a dollar, and actually, seeing how the things are moving. So I think in the age of decimalization, an expectation that we will hit a precise level is kind of an antiquated way to look at it. So I tend to just use thicker trend lines and just sort of mention about 4,200. You'll hear me use a lot of generalities about levels. I usually round to a particular whole number because for me, looking at the chart visually, that's what jumps out at me. I know some people are sticklers for particular levels. I just don't think that's how the world looks anymore. The other thing I'll say, and I'm going to try not to mess up my chart too much here because this is my favorite chart of the S&P. But the other thing, and this is something that Arthur Hill does a lot of times, is he'll actually use a range. So instead of using a line, he'll actually use the rectangle tool and do like a little range like this. And what you want to do is use a color that's a little more transparent. So you can change the transparency over here on the right. And again, on ACP, you have all these same capabilities as well. You'll notice that's how I did some of these other shaded areas on my chart. I tend to think of support and resistance not as levels, but as ranges or zones. And I would encourage you in 2023, I think that's how the world is. I don't think stocks, you can expect stocks to hit a precise level with any reasonable expectation anymore. That's just not how things are at. So I would agree with TJ's assessment that this was absolutely a retest of the February high. I think if you would say no, I think you're ignoring that. It's a nuance about how stocks trade now, and I think that's fairly reasonable to say. Next question, can we scan for stocks on industry or sector seasonality? I love that question so much. The short answer, unfortunately, for now is no. And I'll tell you what you're actually looking for. What you're saying is we have this fantastic seasonality engine, which I would 100% agree. We let you go back up to 20 years. You can actually take a time frame and rewind it a little bit to see over a particular period. And if you look at the dates and if you sort of play with the settings, you can come up with some really cool analysis about how anything with a ticker has tended to trade over the normal 12-month calendar period. You can look at the batting average here on the bottom. Batting average in terms of the height and the numbers on the histograms, and the average return for that month over this time period in the numbers at the bottom of each histogram. We don't let you scan on that yet, but that is one of the many things on our bullet point list for the new scanning engine, which we will be getting to as soon as, we get some of these other things done. But it is in our development queue. One of the things I'd love to be able to say is show me stocks that tend to have a really good May or a really good June relative to this benchmark and have that be one of the arguments that you scan for. So for now, you need to do it, of course, using our seasonality charts. Just click on the top and you can change it to seasonality. You can put a ratio in there. You can compare it to another symbol. We will be adding this to the scanning engine at some point. It's definitely on the list. And thanks so much for that request and for that suggestion. I will tell you, by the way, the more requests we get to our support desk, the higher we tend to prioritize stuff. So if this sort of thing is of interest to you, bang a request to our support desk, let them know what you're looking for, and that'll make sure that we bump it up and prioritize it effectively. Next question, the RSI over 70 is overbought. I would agree. RSI less than 30 is oversold. 100% agreed. What does RSI equals 50 mean? And it's such a great time to ask that question because so many stocks, as well as the major averages, sort of have an RSI right around 50. If you look at the chart of Home Depot over the last 2 years, 100% agreed with how you described in your question how to think of RSI. When the RSI is above 70, that's overbought, which basically means it's gone too high too quickly relative to the normal movement for this particular stock over a particular time frame that you're looking at, and really more a periodicity, daily, weekly, monthly, whatever you're looking at. So when the RSI is above 70, usually means you get a mean reversion move to the downside. It doesn't tell you as much about the longer term trend. That's another way we use RSI, but in terms of the short term takeaway, it usually means we're probably gone a little overheated to the upside. We're probably going to pop down. When the RSI is oversold, which is more common in a downtrend, you often get, at the very least, a little mean reversion move to the upside. So if I was a swing trader, I would use the RSI on a daily chart, probably a shorter term time frame, maybe even a shorter term period on the RSI, maybe on like an hourly or a 15-minute time frame, and I would look at overbought and oversold conditions, and I would be thrilled at picking out some of these short-term turns and just trying to make a little bit on each one and probably be pretty happy. But that's not the way I invest and not how I'm spending my time over the course of the trading day. So your question was, what does it mean when the RSI is at 50? It literally means that the up days and the down days are about average. And what that means is just as the overbought conditions means we've moved too far to the upside, oversold means we moved too far to the downside. When our RSI is 50, the calculation actually means that we've netted out overall to an even momentum picture between the up days and the down days. So in any move, you're going to have up move and down days in the trend. The RSI at 50 tells you an absence of strong momentum, or one side is not enough to overweight or outweigh the strength that you're seeing on the other side. So looking for stocks with an RSI right around 50, these are sort of consolidation moves more often than not. If I was an options trader, which I don't trade options, but if I did, that might be one of the scans I would look for. Things like an RSI right around 50, things like the Bollinger bandwidth very low, or the width of the two bands very narrow, because those would be things that might be ideal for like a straddle or a strangle or some bet that there's a certain expectation of a range bound or lack of a range bound characteristic for a particular stock. That's one of the things I might include in a scan for new ideas. Great questions all, and thank you guys so much for sending those in to us. We have to wrap the show and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market and environment. Here's chart number 1. We talked about breadth deterioration. Again, for our StockCharts paid members, John Murphy, our chief technical analyst, just put out a note earlier today talking about some of the weakness that we've seen in breadth. And I would 100% agree with John's very well-informed take on the trend that we've seen in breadth. While the S&P, the NASDAQ are stalling out just below resistance, we are seeing some areas that are not just stalling out, but are flat out going down. And you see that in certain areas of the market, like energy and financials, and certain sectors and stocks that are struggling to be in anything but a downtrend. But you're also seeing it with the breadth data, right? The advanced decline line on the S&P 500 looks very similar to the S&P itself, which makes sense, right? It's looking at the same basket of stocks. So it makes sense that the breadth is pretty similar. But look at the mid-cap breadth, look at the small-cap breadth, and look at how different that picture is between large-cap breadth and small-cap breadth. The small cap AD line was just so close. I was sitting there with the color code open, ready to change it to red, and I just couldn't do it, but it's really, really close. I almost did it, but not. The breadth is so much different between the large and the small names. We've talked about that on the show a number of times. With a number of my guests this week, we reinforced that idea of narrow leadership and what to do about it. I would be concerned if we start to see breadth conditions not just weaker than the others, but actually breaking down. The small cap AD line is very close to breaking below its March low. If that is the first of others to do it, I would be concerned about potential downside for the markets as a whole. Now, chart number 2 tells you a little bit about why the breadth lines are not looking so ideal. It's because certain areas of the market are very much not near their February highs. Oil services, $OSX on the StockCharts platform is a good example of that. Look at what's happened with oil services stocks. April and May and June of last year, we hit a certain resistance level. We retested that in November of this year, broke above it briefly in January of this year, and then sort of traded around there. Never really followed through too much beyond that initial breakout. I don't have the candle chart on here, but you see a bearish engulfing pattern, some other sort of negative distributive patterns in the short term suggesting upside exhaustion. Then all of a sudden we're back below that resistance level. We're making lower lows and lower highs, and we're once again very, very close to making a new low for the year. Now I've watched the momentum here to see if it's able to hold above that oversold range, but for what it's worth going into the weekend, OSX in a downtrend, relative strength trending down. That is a chart and an area of the market very much struggling. Chart number 3, speaking of struggling, cryptocurrencies are it, right? These are areas of the market that looked very strong about a month ago, right? Mid-April, you have Bitcoin and Ether making new highs for the year. It's starting to look like there's some real upside potential, and I would have put them in the bucket with gold and home builders and semiconductors and mega cap tech as leadership areas. We now have what I would say is now a confirmed head and shoulders topping pattern. Take this head from mid-April, the left shoulder here in March, the right shoulder in May. We've now broken down. Traditional measurement technique says not too much downside, right? 13.5% would take us down to 23,500. That may be the next downside objective for Bitcoin. Folks, that's a wrap for the show and a wrap for this week. All of our previous interviews can be found at StockChartsTV.com and on our YouTube channel. Special thanks to all of our guests this week. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.